Hello legends, it's Guan here. Good to see all of you here today. Thanks for tuning in for today's video. Now Tencent has lost 40% of its market cap in the 6-month period. This is literally Tencent getting shot in the face. With the recent rumours about game banning, does this still present an opportunity? In this video, I'll explore its underlying business, the impact of the news, and the DCF valuation model. So, let's hop right in. The underlying business. If you don't know already, Tencent is literally the Berkshire Hathaway of tech companies in China. To sum it up, Tencent is famous for its communication tools like QQ and WeChat, PC and mobile games, fintech services like WeBank and WeChat Pay, music streaming services, e-commerce stores like WeStore, and more. Now, for some context, their WeChat messaging app currently has about 1.2 billion users, which is comparable to Facebook's total users. Tencent is also the largest gaming company in the world by revenue. And that means if any game publisher or company wishes to enter the China market, they literally have to partner with Tencent, the gatekeeper. And there's a saying that goes, you shall not enter China gaming market without partnering with Tencent. On top of that, Tencent also has a huge investment portfolio where they own Tesla, Spotify, Epic Games, Riot Games, and more. Its estimated listed investee fair value is around $200 billion. Tencent is an incredible cash generating machine. It is comparable to the Fed's printing machine. Just saying. Take a look at the free cash flow history and you'll know why. Now, the news impact. Sure, 10 out of 10 news nowadays are all negatively geared towards the Chinese companies. The wipeout of Chinese private education companies is the #1 fear factor, which literally dropped a bomb that nuked the entire Chinese company's market cap. Case in point, if you don't want to get nuked by Chinese government, click that like, sub, and click on the bell for new video every Friday. There is also another major news that nuked Tencent, and that is the rumor of banning the children from accessing games. Let's debunk this. Tencent says that they will limit the gaming time for minors to 1 hour a day and 2 hours a day during holidays. And the children under the age of 12 will also be prohibited from making purchases within the game. This shows that Tencent is proactive in taking protective measures rather than letting everything go out of control before saving it. It's a sign of prudent management. Case in point, this is not Tencent's first time having their gaming business slapped by the CCP. In fact, CCP actually banned some video game titles back in 2018. As a result, Tencent's gaming revenue fell by 4% in the Q3 2018 due to the prolonged freeze on licenses. And guess what? Tencent quickly bounced back from there. Now, valuations. Let us now understand the potential revenue impact before we proceed to the DCF valuation. In a 2020 chairman's letter, they mentioned that the minors aged under 18 accounted for 6% of China's online gaming GMV. With that in mind, Tencent made about 156 billion renminbi, which is $23.4 billion in total gaming revenue. Assuming that 90% of that is from China, this makes its China online gaming revenue to be $21 billion. Now, assuming that the 6% of this $21 billion is gone, which means around $1.3 billion will be wiped out. In the grand scheme of things, this is equivalent to a penalty fine received by other big tech companies, for example, Amazon, Facebook, Apple, Google, and more. $1.3 billion versus a total 2020 revenue of $72 billion, which is about 2% revenue impact. In all seriousness, this is a small impact, and Tencent is still making money left and right from other businesses. Now, let's take a look at the DCF model. In my DCF model, I've incorporated different scenarios, the bear and the bull cases. So, a bit of caveat here, everything over here will be in the term of USD millions dollars. Right? And as you can see right here, I have made a bear case scenario. As you can identify, a cute little bear image over here, and another bull case scenario right here. So, with that being said, this section is the historical years section with revenue growth, EBIT, EBIT margin, free cash flow as a percentage of EBIT, so on and so forth. And now this section is the forecast, the future period over here, from the year of 2021 all the way to the year of 2025. So that being said, okay, let's take a look at my assumptions. So in this bear case scenario, I'm assuming that they will have a 15% revenue growth, and it will soon drop to 10% of revenue growth. So for this EBIT margin and the free cash flow, the EBIT margin, I'm assuming they will stay at the average of the past 3 years. I'm assuming the future years EBIT margin will stay at the average of the past 3 years. Same thing goes to the free cash flow as a percentage of EBIT as well. I'm assuming that they will be staying at that rate, because I'm assuming that Tencent's business would not have any massive changes, and this is why I'm using that as an assumption. And another thing I'm assuming is that no share dilution and no share buybacks. And more importantly, I'm assuming a 20 times terminal year free cash flow multiple here, in comparison with the Western big tech companies like Apple, Facebook, Google, Amazon, and so on and so forth. I believe these Western big tech companies will be valued at perhaps 25 times or 30 times and so on. But given the fact that Tencent is a Chinese company after all, so I'm giving it a lower multiple, as the investors will probably not willing to give it a higher multiple. In other words, investors are not willing to value it as equal as the Western big tech companies. So that's how I arrived to an enterprise value at a terminal year of about $700 billion, and I'm giving it a discount rate of 10%, given the fact that I believe the regulatory risk is always there. So that's why I'm using it at a 10% discount rate. Now, after going through everything, right, you will arrive to a net intrinsic value of about just shy of $800 billion. Now, Tencent has a huge investment portfolio, which is valued at around $207 billion. So that would then give me just shy of $1 trillion of total intrinsic value. With a current market cap of about $536 billion, this will then give a potential upside of about 86%. And with that being said, this will then give a theoretical intrinsic value per share of about $103 per share. Compare that with the current market price of $57.71, and you get the idea. A huge potential margin of safety right there. So this, on the right hand side I have with me, is the IRR calculation table. So in this case, what you're seeing here is that I'm assuming that I'm buying into one share of Tencent at current price of $57.71, versus that I am selling this one share of Tencent at year 2025 at the price, at the intrinsic value price, which is $103 per share at the time. So given with this, coupled with that theoretical free cash flow per share that I will be receiving, right, I have the net shareholder cash flow table over here with me, and that being said, this will then give me a potential IRR of 21%. Now, in comparison with the S&P 500 market index return, which is at the range of about 70% to 10%. So I believe this 21% is a relatively high. In fact, it's like 3 times of the 7% return that you can get from the S&P 500. Let's take a look at the bull case scenario over here. So let's jump straight to the assumptions. I'm assuming that the Tencent will be able to retain its 25% revenue growth here, and then subsequently it should drop to 20% and also 15% revenue growth. And with that being said, the same thing happens for EBIT margin and also the free cash flow to EBIT margin. I'm assuming they are the same, and the terminal year multiple of 20 times as well, right, with a discount rate of 10% as well in this case. And everything here should give you a total intrinsic value of roughly $1.26 trillion. Compare that with the current market cap of $536 billion, this would then give a potential upside of 136%, which is a huge margin of safety, if you will. And then this would then give a potential intrinsic value per share of $131. Again, on the basis of assuming no share dilution and no share buybacks. Now, for the IRR calculation over here, right, in the bull case scenario, I'm estimating it to be around 29% IRR. Right? Now, are you buying this valuation or not? Let me know in the comments. Be sure to like, sub, and click the bell for more videos every Friday. And I will see you in the next one.